The year is 2012. In a quiet conference room in Manhattan, a team of analysts refreshes a spreadsheet tracking foreclosure auctions across Phoenix, Las Vegas, and Atlanta. Outside, entire subdivisions sit half-empty, lawns browned by neglect. Inside, a single column flashes green, acquisition targets. The bids are ready, the capital is committed. With a few clicks, thousands of single-family homes, once owned by families, now repossessed by banks, transfer not to new homeowners, but to a corporation. On paper, it looks like a recovery trade. In reality, it marks the beginning of a structural shift in American housing. How did single-family homes, the bedrock of middle-class wealth, become a scalable asset class for Wall Street? This is not a story about villains buying houses in the night. It is the story of a financial machine built to solve one crisis that quietly rewired who owns the American dream. To understand this shift, we begin with a collapse. In 2008, the U.S. housing market implodes. Prices fall by more than 30% nationally. According to Federal Reserve data, trillions of dollars in household wealth evaporate. Banks seize millions of homes through foreclosure. By 2011, they are drowning in inventory. Empty homes are not just a social problem. They are a balance sheet problem. A bank cannot easily lend when it is holding streets of unsold property. The problem is clear. How do you absorb a historic glut of housing without pushing prices even lower? The solution emerges from private equity. Firms like Blackstone see what others see as wreckage and interpret it as yield. If homes can no longer be flipped quickly for profit, they can be rented. Scattered houses become a portfolio. Rent checks become cash flow. And cash flow, in finance, can be packaged. The initial promise is elegant. Large-scale investors can deploy capital fast, stabilize neighborhoods by maintaining properties, and provide rental housing to families locked out of mortgages. Technology makes this possible. Centralized platforms manage leases, maintenance requests, and pricing algorithms across thousands of homes. What was once an inefficient mom-and-pop business becomes institutional. Think of it like turning a collection of lemonade stands into a franchise. Each house is a stand. Individually, they are messy. Collectively, they are predictable. But scale requires fuel. That fuel is debt. Here is the mechanism, the plumbing of the system. Step 1. A firm raises equity from pension funds and sovereign wealth funds. Step 2. It borrows billions at low interest rates, amplified by the Federal Reserve's post-crisis policy of near-zero rates. Step 3. It acquires homes in bulk, often at foreclosure auctions. Step 4. It rents them out, generating monthly income. Step 5. It bundles those rent streams into a security similar in concept to mortgage-backed securities and sells them to investors hungry for yield. A rental-backed security is not mystical. It is a bond supported by tenants' monthly payments. If tenants pay, investors get paid. If vacancies rise or rents fall, the structure weakens. In 2013, Invitation Homes, backed by Blackstone, pioneers one of the first large-scale securitizations of single-family rental income. Wall Street has effectively transformed suburban homes into tradable paper. The central paradox is now visible. The tool designed to stabilize housing large pools of capital, absorbing foreclosures, begins to reshape housing into a financial instrument. Homes become less shelter and more yield-generating nodes in a portfolio. The model spreads. By the late 2010s, institutional investors own hundreds of thousands of single-family homes. The logic is compelling. Rents tend to rise with inflation. Housing demand is persistent. Diversification across cities reduces localized risk. Academic papers note the growing financialization of housing. Congressional hearings question the impact on affordability. And then comes the hidden flaw. The model assumes liquidity and price appreciation. It assumes that homes can be bought in bulk without distorting local markets. It assumes that tenants are a stable revenue source and that maintenance at scale can preserve margins. But housing is not a stock, it is hyperlocal. When large investors concentrate purchases in specific neighborhoods, they can influence prices. Studies from the Federal Reserve Bank of Atlanta suggest that institutional buying in certain markets correlates with higher rent growth. What stabilizes prices for lenders can inflate costs for residents. The ticking time bomb is subtle. If home prices rise rapidly, institutions benefit from appreciation. But rising prices also lock more households out of ownership, pushing them into renting from those same institutions. Demand feeds the model that restricts supply. The catalyst arrives not as a crash but as a pandemic. In 2020, eviction moratoriums freeze rent collection across the country. Suddenly, the assumption of uninterrupted cash flow is tested. Companies disclose in SEC filings the percentage of tenants in forbearance. Investors scrutinize occupancy rates. The machine does not collapse, but it reveals its sensitivity to policy and macro shocks. At the same time, record low interest rates supercharge acquisitions. Cheap debt makes it easier to outbid individual buyers. In 2021, reports from markets like Atlanta and Charlotte show double-digit percentages of homes purchased by investors. The line between recovery strategy and structural dominance blurs. Today, corporate landlords own only a fraction, roughly 2 to 3% of all single-family homes nationwide. But in specific metropolitan areas, their presence is far more concentrated. The mechanism persists. Capital pools, algorithmic pricing, securitized rent streams. This is not merely about housing. It is a blueprint. The same architecture underpins private equity roll-ups of veterinary clinics, ETF-driven flows into bond markets, and tokenized real estate in crypto platforms. Identify fragmented assets. Aggregate them. Standardize cash flow. Add leverage. Securitize. Scale. The questions to ask are consistent. First, what problem is this innovation solving? In this case, post-crisis oversupply and bank distress. Second, what assumptions does it rely on? Stable rents, liquid credit markets, political tolerance. Third, where does leverage sit? At the corporate level, often invisible to tenants. Fourth, who bears the downside if the model falters? Investors may lose yield. Tenants may face deferred maintenance or rapid rent hikes. Communities may absorb volatility. The algorithm can process billions in property value in milliseconds. A family searching for an affordable home experiences that shift over years. So return to that conference room in 2012. The analysts were not plotting a takeover of American suburbs. They were executing a rational trade in a distressed market. But rational trades, repeated at scale, become structural forces. The quiet rise of corporate landlords is not a conspiracy. It is the logical outcome of capital seeking yield in a low-rate world, empowered by securitization and technology. It reveals a deeper truth about modern finance. When a basic human need produces predictable cash flow, it will eventually be financialized. Understanding this is not about predicting the next housing crisis. It is about recognizing the architecture beneath the headlines, the pipelines of capital, the incentives embedded in balance sheets, the assumptions hidden in prospectuses. The suburban home is no longer just a place to live. In parts of America, it is also a bond, a data point, a line item in a global portfolio. And once an asset becomes infrastructure for finance, its logic changes. The American dream was built on ownership. The modern market has found a way to rent it back.